Okay, let's get started. Good morning and welcome to today's Tuesday Markets Outlook session. My name is Prakash Vijayanath. I'm a senior analyst here at Options Play. And today I am going to be giving you my thoughts and analysis on the overall market. So before we get started, just a usual disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. Our agenda for today, starting off with the major equity indices, we'll be highlighting some key levels and just see where price is trading relative to their respective support and resistance zones. From there, moving on to fixed income and commodities, we'll also take a look at the sector rotational model, highlighting which sectors are outperforming and underperforming the overall markets. We have seen some substantial sector rotation lately, so that'll definitely be an important part of today's webinar. We'll take a look at some subsectors of interest that I have for you today. And as usual, we'll end today's session with some bullish and bearish market observations. So before kicking off with the major equity indices, just highlighting the Fed rate hike probabilities for the next meeting in around just less than 4 weeks' time on the 22nd of March. So we know that the Fed interest rate hikes have really been a key determinator of price action for the major indices over the last few months. And even though that's somewhat died down in the last couple of months, we've seen that start to pick up, its importance start to pick up more. The markets are now more focused on what the Fed will do once again. You know, we did have a few months where inflation was coming down in line with expectations. We had what the markets perceived to be a more dovish Fed. However, that it is looking like there's some weakness to that perception, especially when you look at the data that's coming out. You know, we have jobs numbers still coming out hotter than expected, a lot hotter than expected. Inflation, it is moving lower naturally, but still coming out a little bit higher than expected. And there hasn't really been any confirmation from the Fed about any dovish confirmation from the Fed or any comments that should be perceived as dovish from the Fed. So for that reason, I do still think that you want to stick to the economic data. You want to look at what the economic data says, as opposed to sometimes what markets are pricing in. Because what we saw in January with the equity rally was markets pricing in a dovish Fed, which there was really no reason for that. I think it was just a risk on environment. People thought that the worst was behind them, which I do believe it is when you look at the price action. That being said, I don't think inflation is and the contributors to inflation is as under control as what people think. So we have here the two potential outcomes for the next Fed meeting, current target rate being at 450 to 475, and Fed futures are pricing in a 78% chance of a 25-point hike to 475 to 500, and a 21% chance of a 50-point hike. Now, I still believe that, a 25-point hike is a more realistic outcome here in 4 weeks' time. I think a 50-point hike would just be too much too quickly. That being said, if you look at the trajectory of, the probabilities of a 25-point hike, a couple of weeks ago, it was at around 99%. Now it's at 78%. So markets clearly pricing in a more hawkish Fed. I think realizing that, the economic data just doesn't align to what the price action in equities was doing. And also, I do want to point out that, yes, the Fed could increase rates a lot higher than the 5% that was their original target. We knew by around 5% or just above 5% was the original target. However, that the Fed could increase rates a little bit more than that. Markets have not priced it in. That would cause equities to decline a little bit further. Also, they could keep interest rates elevated for longer to combat inflation. Right now, word on the streets is more starting a cut at around the November time for interest rates. And, that just depends on the data that comes out up until then. I know it's still a long time away, but equities are forward-looking and will price that in if interest rates are expected to stay elevated for longer than originally anticipated. All right, moving on to the S&P 500 using the SPY ETF. And what we have here is, we saw on the weekly time frame this capitulation form inverted head and shoulders pattern, and the 50% fib level acting as the market bottom, 38.2 fib level at 380, acting as the most recent area of major support. Price did consolidate early in the year, followed by the January rally that we saw. And price was unable to really break above that 420 level, which is in line with the 23.6 fib level. So that risk on sentiment has clearly dissipated over the last couple of weeks. I think, like I said earlier, I think markets were just getting a bit too optimistic too quickly. And now we are seeing that reversal lower here for the S&P 500, breaking below its 21-day exponential moving average, and as well as its 55-day exponential moving average. That could see a continuation lower. The big question is how much lower can it go? I still see some support just above 390, between 390 and 395. I would call that minor support, but we have major support at 380. And my overall sentiment for the S&P 500 is still quite neutral. I think the price would be range bound, or there's a potential for the price to be range bound between the 380 and the 420 level, unless it finds support here at around 395 or so. That could act as the other area of support. But until we get a strong fundamental catalyst, or at least some news regarding the Fed maybe not being as hawkish as they are, or anything interest rate related, really, I don't really see us breaking above that 420 level. It is only a matter of time, but we do need a fundamental catalyst to break above that level and continue higher here for the S&P 500. Right, moving on to the NASDAQ 100 over here, and similar price action with major resistance that are just around the 300 area, price struggling to break or stay above 300. It did find some resistance at 310 as well, but overall the area between 300 and around 315 is acting as a strong area of resistance. We saw a very strong rally, price reaching an overbought condition. Naturally, momentum started to decline, and price actually forming a new lower low on the daily time frame, finding support in the 55-day exponential moving average. And still, even though it bounced higher initially, yesterday it did move lower intraday and sit open a little bit higher this morning. But again, we are seeing a lack of momentum on a daily time frame. So even when you do see price move open a little bit higher, it's unable to keep that momentum throughout the session. And we are seeing just an overall lack of momentum, which does lead me to believe to have a more neutral, to maybe even a slightly bearish sentiment for the NASDAQ 100. Also important to remember that the NASDAQ 100 is largely exposed to technology names and growth names, which are more sensitive to any changes in interest rates hike policy. So expect more volatility for the NASDAQ 100, but overall a similar direction to the S&P 500. Next key area of support that I do see below 290 would be at 280, and then you have 270 as well. So those would be the key levels of support here for the NASDAQ. And we'll have to see how price really reacts over the next few days, whether it actually breaks below 290 to get to the 280 level, or if it uses 290 as a more solid area of support. But again, sentiment's definitely a lot more neutral than before. Right, moving on to small caps, we have the IWM Russell 2000 ETF, and impressive relative performance in my opinion. Still outperforming the large cap names. Yes, it's moving lower, but it's still staying above a key area of support, which is the 38.2 fib level. Sorry, I did crop that out slightly, but it's a 38.2 fib level at 188. So on the weekly time frame, we have a few key areas of resistance and support defined by the fib levels. 23.6 at 210, 38.2 at 188. Previously acting as resistance for almost most of 2022. We saw that price broke above it on a daily time frame, and we are seeing a pullback. We're not getting the initial bounce higher with momentum that you normally see after a breakout and a pullback. But again, sentiment across the board is more neutral. But the fact that price is staying above 188 is still quite encouraging here for small caps. If price breaks below that level, you have around 180 as a potential minor area of support, but 170 would be the major area of support, which would be the 50% fib level here on the weekly time frame as well. Okay, taking a look at bonds using the TLT bond ETF. So bonds have been under pressure in the last couple of weeks. And this has to do with, again, a more perceived hawkish Fed. The fact that interest rates could be elevated for longer, or could even be moving a little bit higher than expectations. And naturally, markets would have to price it in. What we saw on the weekly time frame is a very standard bearish trend, a very, I would say, a very violent bearish trend, but still, clearly defined by lower highs and lower lows. And more recently, we just see price pop up a little bit higher, back to that 108 area, which was a previous swing low, turning resistance, clearly acting as resistance, but we didn't really see that much of a price reversal. We see there was a lot of consolidation, and it wasn't until earlier this month when market sentiment started to shift that we saw price continue to move lower here. Big question is whether this area at 100 will act as support, strong psychological level, previous area of support as well, and already price is starting to bounce up a little bit higher from that area, but not with a lot of momentum. So that could act as support. And I will say that I don't believe price will really reach the 92.50 level unless something crazy happens with markets, unless we get, surprisingly much higher inflation, which I don't think we'll get. So I don't believe 92.50 will be reached because we know where interest rates are heading. When bonds were moving lower and with a strong bearish trend and price did reach the 92.50 level, it was during a period where we didn't know how high interest rates could be. We knew that they were moving higher, but there wasn't really a target, whereas now there is a bit of a target. And that did help TLT find some support and some stability. But it looks like for now could potentially be range bound between 100 and 108, unless we see a breakdown below 100. And taking a look at the US dollar, so the US dollar has actually reached our price target over the last couple of weeks that I mentioned at 105.50, and already, very quickly bounced, rejected that level yesterday with a strong bearish candle. I'm not saying there's going to be a reversal here. I think the macro fundamentals over a short term does point to a stronger dollar. However, 105.50 clearly acted as a resistance level after the bounce from 102, between 100 and 102 support. There is still a lot of momentum, as you can see on the weekly time frame. So we could see a break above 105.50, especially with a more hawkish Fed. That tends to lead to a stronger dollar. And we could see, a break above that key area of resistance and price head towards 107.50. That would be the next key area of resistance here for the US dollar. And that would naturally have an adverse impact on gold. So gold moves inversely to the dollar. Yes, it's a safe haven. And yes, we saw a lot of momentum and rotation into gold over the last few months as investors were naturally fearing, we're having a lot of recession fears. But since then, we have seen a significant pullback. I still view this pullback as a good buying opportunity for gold. We just need more bullish confirmation. So after this pullback, price broke below two key areas support at 177 and 171. And we are seeing a little bit of a bounce from that 167 area of support, but price hit to open a little bit lower this morning. I think the weekly time frame shows just how much bearish momentum there is here on this move. So we need more confirmation for that bullish entry point for gold, especially as recession fears continue to grow. But a stronger dollar doesn't really help. So the next key areas of support that we could see a potential reversal would be, at around, I would say 165. Let me get the price up here. Sorry, 165, or even around the 160 area. Those would be the two key downside targets for gold, where we could see some bullish price action and potentially a reversal higher. And taking a look at oil, and honestly, not much to say again about oil, still the same story from the last couple of months, where price is essentially at equilibrium between 81 and 70 when we're looking at the light crude oil futures. So on the demand side, we have the Chinese reopening. That's naturally going to help elevate oil prices. But we have recession fears as well that is going to naturally keep oil prices lower. So that equilibrium, in my opinion, has definitely been reached. And that is why we are seeing price bounce below, between 81 and 70. And we will need a strong fundamental catalyst to see either an upside break or a downside breakdown, with the next key area of support being at around 61. So for energy names, we have seen that the rotation out of energy, you know, we have, and especially when you consider the fact that energy was such a strong sector in 2022, it is now becoming very quickly one of the more weaker sectors here in 2023. Okay, taking a look at sector rotation, we now have 4 sectors in the improving and leading category and 7 in the lagging and weakening category. And some pretty interesting rotation that we've seen. Communications did move into the leading category last week, providing some leadership. And this has to do a lot with the fact that Meta or Facebook has such a huge component within the sector. And they had a very good earnings announcement a few weeks ago. So that has naturally helped boosted the entire sector itself. We also have technology rotating into the leading category. And what I find quite interesting here is usually when technology is in the leading category, we tend to see the major equity indices continue to move higher. And this has to do with the fact that XLK has around a 28% weighting on the S&P 500. And during the whole period, pandemic recovery period, we saw that technology alone was a sector that was able to drag the major indices higher. But we're not quite seeing that happen this time. We are seeing the major indices under pressure despite good technology performance or good relative performance here from technology. And that just has to speak to the fact that the other sectors are suffering. When you look at financials, materials, industrials, and energy all losing that momentum and relative strength. And even the defensive sectors in utilities, staples, and healthcare losing a lot of relative strength and moving into the lagging category. So the first time in quite a long time that we've seen all 3 defensive sectors in the lagging category. I would say that's a little bit confusing to me because we are at a time of, I would say, some uncertainty with markets as to what will happen next. We don't really know what the Fed's plan is just yet. So there is a uncertainty there. The VIX has creeped up as well. And normally that's when we start to see more rotation into defensive sectors, but we haven't quite seen that just yet. Sorry about that. I was just coughing. But we haven't quite seen that rotation with defensive sectors. So I would say, this is still the weekly rotational chart. So there is a lagging component. And I know there are some opportunities within staples, which I think has remained quite neutral during a time when markets are bearish. I still think there's opportunities within healthcare that are sold off quite heavily due to an oversold condition, and it provides good buying opportunities as well. So I'll still keep an eye on these defensive sectors. But it is quite interesting to see the fact that there is such strong rotation out of defense in general. Okay, taking a look at our first subsector of interest, and that is biotechnology. I know we've looked at this for the last few weeks, and this was a trade that really worked in our favor. You look at the weekly time frame and you identify 134, 135 as a major area of resistance, and it was on the weekly time frame. But more recently, I prefer to use 138 as an area of resistance because price really invalidated the 135 level more on the daily time frame, and 138 became a new area of resistance where price was struggling to break above it. We identified this opportunity when price was at around 136 and was struggling to break above 138. And this gave us good risk to reward bearish entry points. All that moved lower. There was initially a small retracement higher, but now we are seeing a continuation lower once again with a lot of bearish momentum, breaking below 128, which was key. That was a potential area of support. And the fact that price has broken below it, even yesterday had an intraday retest, does indicate a continuation lower. And the next key area of support here is at 122. The one thing I will say is that price on a daily time frame has now approached the oversold condition. So we may see a bit more of consolidation or a slight retracement higher before a move lower here for the biotechnology ETF. Next, we have the home builder ETF, XHB. So home builders, I still like home builders despite the recent decline, and that has to do with the fact that from a relative performance perspective, home builders is keeping up quite well. Overall, still maintaining a bullish trend, price finding support at the 55-day exponential moving average after this move lower. And it did initially break above the $70 key area of resistance, but couldn't quite sustain that level. It was quite overbought. But we are still seeing price, hold up quite nicely. So I would like to see more bullish confirmation before entering a bullish trade for the move higher back to 70 or potentially above. But the fact that price hasn't really shown that momentum or yet leads me to believe that now is not the right timing. It is still definitely a name to have on the watch list though. And next, looking at DRIV, which is the Global Autonomous and Electric Vehicle ETF. So I still like this name, very similar chart to that of home builders, where we are seeing price find support once again at the 55-day exponential moving average after initial reversal lower from that 25 area of resistance. Set to open pretty much at the same level that it closed at yesterday, this morning. And I still think that, a bit more bullish confirmation would lead me to believe that price would be on its way back to that 25 area. Overall, though, DRIV is holding up quite well against the overall market. And a big reason for that is because Tesla has such a strong weighting within this ETF. And if we take a look at Tesla's price action over the last few weeks, it's been quite impressive. We had a bit of a topping formation, head and shoulders, if you will, and break below that 200 area, and price declined all the way to about 110, where it found some support, and early on this year, moved higher with a lot of momentum, breaking above some key levels. Right now, price in the daily time frame, as you can see, we have seen a moving average crossover between a 21 and 55-day EMA, but it has lost some momentum on the daily time frame, kind of pulling back to the 21-day exponential moving average, but already bouncing higher and set to open higher again this morning. So Tesla, fundamentals are looking on the up once again. And the fact that, they're about to launch a new car that's more affordable, it really speaks to the fact that we're about to enter a new era of electric vehicles that are a lot more affordable for everyone. So, especially a big name like Tesla doing that is quite significant. So Tesla's fundamentals and macro outlook does look quite good, and it is definitely keeping the DRIV autonomous and electric vehicle ETF up. Next key area of resistance, though, would be at 277 for Tesla, or even around 230, 235 as well. Those are previous minor area of resistance. Okay, taking a look at Roku, another name that we looked at last week, and Roku was all about playing this range-bound market with around 80 acting as resistance and 60 acting as support. So what we've seen over the last few days was a very strong rejection of this between 75 and 80, and a very strong move lower back to 60. But look at yesterday's price action. We have an intraday bounce, and that does indicate a nice risk to reward bullish entry point for that move higher back to between 75 and 80. Roku did have a positive earnings announcement quite recently as well. And it really has, kind of invalidated this bearish structure, at least on a daily time frame, where 60 was acting as a major area of resistance, now turning support. So very good risk to reward bullish entry point here for Roku for the move higher to around 75 or 80. Moving on to IBM. So IBM has been a name that we've looked at for a couple of weeks now. And that has to do with the fact with the weekly time frame, 150 has acted as a major area of resistance, and around that 110 to 120 area has acted as a major area of support. This has been the case for multiple years. More recently, price was at the 150 level, strong rejection, and we've seen a pretty systemic decline. Strong move lower, followed by an exhaust retracement, and followed by another strong move lower, and the previous swing low at 137 acting as a new area of resistance. We had identified this potential trade setup at around, when prices are at around 136, struggling to break above that 137 resistance level. And now we are seeing a continuation lower, breaking below that 130 area of minor support as well. So that is quite significant, and it does lead me to believe that there is further decline in store, with the next key area of support being at around 120. Okay, taking a look at Johnson & Johnson. So this is part of the healthcare sector. And overall, it has performed quite poorly in the last few months. You can see on the weekly time frame, after price reaches 180 major area of resistance, it's just been a one-way ticket all the way back down to 155. Very strong bearish move here, very limited retracements. But price is now reaching an oversold condition, and it's reaching an oversold condition at a major area of support at 155, a multi-year area of support. So the risk to reward here does point to the upside. However, I would like a bit more bullish confirmation for that entry point, because we have seen very little bullish price action over the last few days. So let's see how this plays out over the next few days. If we do get some bullish price action at 155, because that will provide an excellent bullish entry point for the continuation higher to potentially 170 or even 180. And with that, that is all I have for you today. Thank you so much for joining me, and I hope you all have a great trading week ahead.